Hey everyone, and welcome. The world of accounting loves precision, certainty, right? But what happens when things get messy? When a business is facing a lawsuit or a warranty claim, something that might cost them money or might not? Well, today we're going to tackle that fascinating gray area, how to account for the unknown.
And that's really the million-dollar question, isn't it? How do you put a number on a maybe? You can't just stick your head in the sand and ignore it, but you also can't just book it like it's a sure thing. Turns out there's a whole framework for this, and that's exactly what we're going to walk through right now.
All right, let's kick things off on the bright side. Let's talk about contingent assets. Think of these as the potential wins a company might have just over the horizon. Okay, that sounds a bit dense, so what does it actually mean? Well, imagine your company is suing another company for stealing a patent. You're pretty confident you're going to win a big settlement. That potential payday, that's a contingent asset. See, it comes from a past event, the patent infringement, but whether it becomes a real asset or not totally depends on a future event you can't control, the judge's final decision.
Yep, that's the long and short of it. It's a possible gain, not a guaranteed one. It's this potential cash inflow that might happen, but there's absolutely no certainty yet.
And this right here, this gets to a core principle in accounting: prudence. Accountants are, by their very nature, a cautious bunch. They avoid recognizing income that might just be wishful thinking. It's literally the don't count your chickens before they hatch rule, but for accountants. And that's why you won't find contingent assets on the balance sheet. They only get recognized when that income becomes virtually certain.
Okay, but what about the flip side of that coin? Because that same cautious mindset means accountants are extra careful about potential downsides. And this brings us to contingent liabilities.
Now, this definition probably looks super familiar, right? It's pretty much the mirror image of the contingent asset. It works the same way, just in reverse. We're talking about a possible obligation. So if your company is the one getting sued, now you've got a contingent liability. You might have to pay up, but the outcome isn't decided yet. It's a potential cash outflow.
To really wrap your head around this, it helps to think of all these obligations on a kind of spectrum. On one end, you have vague maybes, and on the other end, you have concrete, we absolutely have to pay this kind of musts. Figuring out where a situation falls on this spectrum is what tells accountants how to treat it.
So the first big dividing line is between present and possible. A normal liability is a present obligation. It's a bill you already owe, like a loan you've taken out. A contingent liability, on the other hand, is just the possibility of an obligation. It hasn't turned into a definite you must pay this now situation, at least not yet.
And this is where it gets really interesting, because in the world of accounting, there's actually a third category that sits right in between a definite liability and a merely possible one. And this brings us to something called a provision. And here is the absolute key to everything. A potential loss only crosses the line to become a provision and actually gets put on the balance sheet when two specific conditions are met. First, the outflow of cash has to be probable, not just possible, but likely. And second, you have to be able to make a reliable estimate of how much it's going to be. If you fail on either of those 2 points, it stays a contingent liability, which, and this is crucial, is only talked about in the notes to the financial statements, not on the balance sheet itself.
This is where it all comes down to a judgment call by management. Let's say a company gets fined, and they appeal it. If the managers think, you know what, it's probable we're going to lose this appeal, they have to create a provision. But what if they're optimistic? If they think they're likely to win, well, then the cash outflow isn't probable, so it's not a provision. It's simply disclosed as a contingent liability in the footnotes.
All right, so let's zoom out and put all these pieces together. What's the big picture? Why do we even care about these subtle differences between all these terms?
Think of this as your quick reference guide. Liabilities and provisions, they hit the company's books directly, right there on the balance sheet. A contingent liability, that's a, hey, just a heads up, watch out for this item that's tucked away in the footnotes. And contingent assets, they're kept almost completely off the books because of that old prudence principle.
And this, right here, is the most important thing to take away from all this. When you look at a company's financials, the big numbers on the balance sheet only tell you part of the story. The real juicy details about potential future disasters, the massive lawsuits, the regulatory battles, they're often hiding in plain sight in the footnotes as contingent liabilities. Understanding this lets you see the hidden risks that aren't baked into the main numbers yet.
So I'll leave you with this. The next time you pick up an annual report, don't just stop at the profit and loss. Be a detective. Dive deep into those notes at the back.
because now you know exactly what to look for, the company's hidden story of its what-ifs, all laid out for anyone who knows where to find them. Thanks so much for joining me.